So Urban Outfitters narrowly missed EPS consensus, but they beat on revenue. EPS came in at $1.72, which misses the $1.73 estimate by a penny.
Literally just a penny.
Right, literally 1 penny. But revenue hit a record $1.66 billion. That beats the $1.65 billion forecast, and it's up 10.4% year over year.
Oh, wow. Okay.
Yeah. And looking at the forward guidance, Q3 total sales are projected for high single-digit growth, but the real standout is Nuuly, their subscription service, which is expected to jump in the high 20s.
Which is massive.
It really is. So URBN stock surged 9.46% in regular trading, near a 52-week high, but then it slid roughly 3.6% after hours to around $80, following that slight EPS miss.
Right, and that after-hour slide is exactly why we're doing a deep dive into these numbers today. Because, how does a major retailer post record revenue and still manage to spook Wall Street?
Yeah, exactly. Well, to understand the underlying business drivers there, I think you really have to look at their multi-brand strategy, like a well-diversified mutual fund.
Okay, I like that comparison.
Right. Because if one asset lags, the others just kind of carry the weight.
Right.
So Free People saw revenue spike 15%, and Nuuly surged a massive 29%.
Yeah, it's a textbook hedge. And looking at the profitability metrics, gross margin ticked up to 37.7%.
Nice.
And operating income rose 11% to an all-time high of $193 million. Management actually made a point to highlight that this is their 8th consecutive quarter of record sales and profits.
Wait, 8 quarters?
Yeah, 8 in a row. And they're using that momentum to drive this goal of having $5 billion plus brands by 2030.
Okay, wait, let me push back on that record profit narrative for a second, though.
Sure, go ahead.
Because if the top line and the margins are breaking records, what is pressuring the bottom line and scaring those after-hours investors?
Yeah.
Like, they have a massive $475 million planned CapEx for fiscal 27, right?
Yeah, they do.
And that's heavily allocated to AI investments in these massive new fulfillment centers. So isn't that aggressive spending basically acting as a drag on short-term EPS?
Well, it undeniably is a drag on the near-term earnings picture.
Yeah.
But you have to look at the immediate notable risk management highlighted. It's not just the CapEx doing the damage.
Okay, what else is hitting them?
They pointed specifically to Section 301 tariffs.
Right.
Which means essentially 50% tariffs on goods coming from India.
Oh, wow, 50%. That is steep.
Yeah. And on top of that, there are inbound freight fuel surcharges tied to the ongoing conflicts in the Middle East.
So wait, you bring in a container of apparel from India, it costs 50% more at the border, plus the shipping itself is way more expensive just to get it there.
Exactly.
That completely destroys your gross margin on those specific items.
It's a massive squeeze on profitability, absolutely. But they are mitigating it. They're aggressively negotiating better terms with vendors to sort of, force them to share that margin pain.
Makes sense.
And they're dynamically shifting countries of origin, moving production away from India where they can.
Which takes time, obviously. You can't just move a supply chain overnight.
It takes a lot of time, yeah. But it's what they have to do right now.
Well, wrapping up this deep dive, I want to leave everyone with a provocative thought based on Nuuly's explosive growth.
Okay, let's hear it.
If a traditional retailer scales a rental subscription this aggressively, does it eventually cannibalize their core apparel sales? Or is it just the ultimate hedge against fashion fatigue?
Man, that is the million-dollar question. We'll have to see if renting the runway ends up burning down the store. Follow the show for daily earnings coverage.